There's nothing like Bitcoin on a day where people are enthusiastic and the euphoria is, flying around, because it'll go up thousands of dollars. The reverse happens as well. It'll drop thousands of dollars, right? I mean, people go back. I saw some people being like, oh, this is like March 2020. March of 2020, Bitcoin dropped from $8,000 to under $4,000. 50% drop in a single day. That is very difficult to happen in the stock market because of the circuit breakers and a bunch of this stuff. There are times where they'll even just shut down trading of something and just say, everyone just go home, right? And so when you see this happening in kind of the Bitcoin and crypto world, you just have to remember that as these people get wealthier and as these people get older, they will start to diversify into kind of more traditional markets. And so we're really training an entire generation of people to be better in terms of understanding volatility, being long-term oriented, and kind of prepared for these moments. If you don't get excited when the assets in your portfolio go down in price, you may not actually understand what you own.
Pomp starts by addressing a fundamental truth of investing. If you're not excited when the assets in your portfolio drop in price, you might not fully grasp what you own. He shares his personal experience with Solana, explaining how its price fluctuated dramatically from $40 to $200 and then back down. This volatility, according to Pomp, should not cause fear for those who have invested with a long-term horizon. Instead, he advocates for a mindset where price drops are seen as opportunities rather than threats. He highlights the importance of being continually allocated to your portfolio and maintaining confidence in your investments despite market downturns. For Pomp, the key is to avoid leverage and not worry about short-term price movements, even if they are drastic. He emphasizes that holding assets for the long term reduces the stress associated with daily market volatility and prevents irrational decisions driven by fear. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
If you don't get excited when the assets in your portfolio go down in price, you may not actually understand what you own. And when I see this go down, now take something like Solana. Solana has gone from $40, $50, $60, $70 when I started to buy it last year, and ran all the way up to $200. Came back down. It actually went to like 125, went right back up to like 180, right? It's come back down, whatever. And so what you want to do is you want to constantly be allocated to your portfolio. And if you buy things with a very long time horizon, when the price draws down, you don't worry, right? So last night when everything was kicking off, it was almost like you just kind of sit down and you're like, here we go. Here comes the fun. But you're not worried. You don't have leverage. You're not worried about getting liquidated. You're not worried about what the day-to-day price movements are, even if it goes down 50+%, because you're saying to yourself, I'm holding this for years. And if I'm going to hold it for years, who knows what's going to happen? Right? So I shouldn't worry about today. And so the long-term mentality is actually this great anecdote to the like fear and panic in these moments. And then I also think that when you see something like crypto drawing down, because it is so volatile, it bounces really hard. So earlier today, we saw Bitcoin drew down. I saw a $49,000 print, right? I think it was like $49,700. I looked maybe an hour later, it was back to $54,000. And so when you see those kind of hard drops, it's the reflexivity in the market. So you see something go down very, very quickly and it comes flying right back. That literally could not happen in the stock market because of the circuit breakers. And so they constantly are interrupting these kind of violent moves in either direction. And so a free asset like Bitcoin or the crypto market shows you much more about human psychology and how markets are supposed to work. And so I think that's actually one of the advantages that the crypto world has, although the traditional finance folks look at it as a negative. They say it's too volatile. They say it's too much of a free market. That is, as an investor, that's what you want. Right? You want an unencumbered kind of signal as to what's going to happen in the world. You want to be able to take a bet on that versus have to analyze not only what is the financial asset, what is the market conditions, but then, hey, are they going to intervene in some weird way that's going to change the financial performance of this asset? There's nothing like Bitcoin on a day where people are enthusiastic and the euphoria is, flying around, because it'll go up thousands of dollars. The reverse happens as well. It'll drop thousands of dollars, right? I mean, people go back. I saw some people being like, oh, this is like March 2020. March of 2020, Bitcoin dropped from $8,000 to under $4,000. 50% drop in a single day. That is very difficult to happen in the stock market because of the circuit breakers and a bunch of this stuff. There are times where they'll even just shut down trading of something and just say, everyone just go home, right? And so when you see this happening in kind of the Bitcoin and crypto world, you just have to remember that as these people get wealthier and as these people get older, they will start to diversify into kind of more traditional markets. And so we're really training an entire generation of people to be better in terms of understanding volatility, being long-term oriented, and kind of prepared for these moments. Everyone is scared, but I don't think that they should be yet. I think there's a couple of different components to this. First of all, we have high interest rates in the United States. Yes, historically, they're not that high, but they're high compared to the 0% interest rate environment that we've had. And so the Fed has had multiple data points. Unemployment's been creeping up. The economy's obviously been slowing down a little bit to cut interest rates, and they haven't done so. And so if you leave interest rates high for a long time, you eventually break something in the economy, right? If you think about the United States economy, it is built for low interest rates and cheap money. That is how everyone grows, and growth is the oxygen for the economy. So that's kind of step one, is just structurally, you've got higher interest rates, so that creates a lot of issue. The second thing is that people have been pouring tons of money into the stock market, right? If you have 5.5% interest rates, but the stock market's at all-time highs, that's not supposed to happen. And so obviously people have been very bullish and optimistic. They're trying to front run some sort of pivot from the Fed, and they keep pouring money into the stock market. Now, where are they getting that money? A lot of it is because they're getting wealthier because of various things in the economy, and there's more cash that they have to go and invest. There's hundreds of millions of dollars that are actually coming in via this carry trade, because what a lot of investors figured out is that the Japanese yen was in an environment where there's a 0% interest rate. So rather than borrow money in the United States at 5.5%, I'd rather go to Japan and borrow at 0%. Well, if I borrow in Japan, they don't give me dollars, right? They give me JPY. And so what I have to do is I have to take that and I have to convert it to dollars. So I borrow in Japan at 0%, I then convert it to dollars. Well, now I have dollars and I owe 0% on that loan. What do? I go buy stocks. Sounds amazing. Well, all of a sudden what started to occur is as I was buying those stocks and it was going up, I felt like a genius. Now there's two things that occurred. One, the Japanese started to tighten their financial conditions. Oh, hold on a second. It may not be 0% interest rates now. I may actually owe something on this money. That's a departure from why I did it in kind of the original environment. The second thing is, as stocks have kind of pulled back some, then I now have essentially leveraged bets in the stock market. If those stocks start to trade down, I now get worried about some sort of margin call. And so what I have to do then is sell stocks to go pay back my loan. But if I'm selling stocks, and so is a lot of other people, it further pushes prices down, causing more of a cascade in the market. And so what you get here is you get a number of different dynamics that are all coming together that are leading to these lower prices. Now, maybe the most important part of all of this is we live in an economy where the structure of monetary policy is going to constantly push asset prices up. But because we've essentially removed risk from the market, people will do things that take on more and more risk, right? Imagine if you could go to the casino and you knew you couldn't lose. What would you do? You would just start wagering more money. But on the off chance that the Federal Reserve is not paying attention, like when they have interest rates at a high rate for a long time, then what you start to do is you start to introduce more of that risk, but people still are convinced there's no risk. And so stocks start trading down. They're caught, kind of with their pants down because they're over levered. And so then you get panic and fear. It's hilarious to me. The S&P is still up double digits year to date. Yet people are acting like it's down 20%.
A significant portion of Pomp's analysis is dedicated to the carry trade dynamics involving the Japanese yen. He explains that many investors have been taking advantage of Japan's zero interest rate environment to borrow in yen and invest in higher yielding assets like stocks. However, as Japan tightens its financial conditions, this trade becomes less attractive, forcing investors to unwind their positions. This unwinding can lead to a cascade effect, where selling pressure in one market spills over into others, exacerbating market declines. Pomp illustrates this by pointing out how changes in Japan's monetary policy can have ripple effects across global markets, including US, highlighting the interconnectedness of the modern financial system.
It is always funny to me that, our grandparents prayed for days like we have in 2024, where the stock market is up double digits halfway through the year, right? With a stock market that compounds usually at 7-8%, maybe 10% on average over the last 50 years, that's a year-long return. We were annualizing close to 30% in the S&P at kind of the half-year mark. And so because of that performance, people got used to everything goes up and to the right. And so the first sign of, oh, wait a second, stocks don't only go up all the time, every single day, right? If you go and you look, I think the S&P didn't have a 2% drawdown for a year. And so when that occurs, when you get the 2% drawdown, everyone's forgotten what it's like when stocks go down a little bit. And if you then take not only the stock performance and kind of the fear that's driven there, I do think that there's a lot of people who are looking at the presidential election in November, and they're trying to understand who's going to be the president. If you overlay the chart of the S&P with the prediction odds of Donald Trump becoming president, when Trump's odds go up, the stock market goes up shortly after. When Trump's odds go down, the stock market goes down. And so what's hilarious about this is that people are almost day trading the gyrations in Trump's prediction odds in the stock market. Whether they're doing it implicitly or not, they are trying to better understand, are stocks going to accelerate or is there an incoming recession? And the short answer is nobody knows for sure, but we do know that you're not supposed to have an all-time high in the stock market with interest rates this high. And so I also saw that I think a 1,000-point drop in the Dow happened this morning, which had never happened in history before. And so, some of this is financial moves, but I think another important part of kind of this whole analysis is we lived in this hyper-connected world. And so the information velocity is unmatched. Historically, on a Sunday night, you would have no clue what happened in Japan. Maybe you worked at a big financial firm that had a desk in Japan. And so somebody would pick up the phone and call or send an email and say, hey, things are looking a little shaky out here, right? And you might not even know what it was, but you would at least say, okay, maybe something's going on. When the stock market opened in Japan yesterday, all of Twitter knew exactly what was going on, to the point where they were calling out percentage point ticks of the decline, which then creates fear, which creates this uncertainty, right? Which creates this panic, which then starts to spread everywhere else. And you can literally see, if you were to plot the velocity of tweets that were talking about this stuff with the decline, my guess would be that as the tweet velocity increased, the sell-off accelerated as well. Because people said, oh my God, I read on Twitter that the Japan, stock market is blowing up. Well, tomorrow they're going to open up the American one. I'm going to go sell something. And so that velocity of information is actually a huge driver of financial performance in a way that we just never seen before. And so I do think that that's a big element that they're not going to be able to change. And as individual investors, we should prepare for that only to get worse over time.
Pomp also explores the role of information velocity in today's markets. In the past, information about financial markets moved much slower, giving investors more time to react. However, in the current digital age, news and market data spread almost instantaneously through platforms like Twitter, amplifying market reactions. He suggests that this rapid dissemination of information can lead to exaggerated market movements as fear and uncertainty spread quickly among investors. This creates a feedback loop where negative news can drive selling pressure, which in turn leads to more negative news and further selling. Pomp emphasizes that this phenomenon is a new challenge for investors, one that requires a cool-headed approach and a strong understanding of market fundamentals. Please like and subscribe my channel.